Hello, hello. All right. So have, if you're a barbershop owner or hair salon owner and you've spent, let's say, $5,000 making improvements or renovating your salon or your barbershop, I want you to listen closely because all of that money may not be tax deductible in the year that you had the expense. And it is one of the fastest ways to get flagged by the IRS when you categorize a repair, when you categorize something that's supposed to be expensed over what's supposed to be just written off as a tax deduction. So I see this get in the way for a lot of salon owners and barbershops that they're like making improvements and renovating their salon or their barbershop. So that's what we're going to talk about today. My name is Jennifer Drew. I'm the founder and CEO of Hair CEO. We are a business advisory and accounting firm working with self-employed hair professionals and hair business owners to make sure that they run legitimate businesses, profitable businesses, but most importantly, bankable businesses. And this is one of those things that can really tip the scale when it comes to how you look when you're trying to get loans for your business, whether you're trying to expand or improve cash flow. So that's what we're going to be talking about. And if you are joining me live, we have Tara in the comments, and she's going to be answering any questions. So if you are with us live, say hi in the comments to let Tara know that you're here. If you are catching this replay, do hashtag replay just so I know that you were here. All right. So when it comes to the tax world, we look at three things. We look at betterments, we look at adaptations, and we look at restorations. And so those three things, you might be like, what the heck? So I just want to talk about it in simple terms. You have repairs and then you have improvements. And so when you're thinking about repairs, you're thinking about what is it that you can have your business pay for that keeps something operating on a regular basis versus what is an improvement, and that's something that is going to make something better or extend its life. So that's what I want you to think about when it comes to the different types of deductions that you have. I need some water. All right, so I want to give you an example of this. I have a client. He is a salon suite owner, a location owner. So he's not just working in a suite; he actually owns the salon suite business. So he rents out suites to other people. And so he had two issues going on in his salon suite. One was that one of the sinks in his tenant's suite was leaking water. And then also, the tenants were saying that the water wasn't staying hot long enough. So he called a plumber, and the plumber came out and basically gave him a quote for fixing the leak. But then also, he mentioned that for the reason why he's having an issue with the water not staying hot for all of his tenants is because the water heater is actually too small and he needs a larger water heater. So, with that invoice, because he decided that he wanted to get both fixed, the leak, and he wanted to upgrade the water heater to something bigger. So with that invoice, we actually have to categorize that as two totally different things. It doesn't go on the tax return the same way. So the repair is tax deductible that year. Let me give you a visual because this is better. I wrote this out. So we have the repair that's going to be tax deductible the year he spent the money. So for him, this happened in 2025. So the leak going to be tax deductible 100% the amount that he paid the plumber to get it fixed. But the water heater upgrade, right, to a bigger water heater, not going to be fully tax deductible necessarily in 2025 because that's considered an improvement. So let's talk about what the IRS kind of logic is when you're trying to figure out, do you have a repair or do you have an improvement? Because it's going to directly impact what you can write off. So the IRS logic is that if you are keeping something running in your business, then this is going to be a repair, and this is going to be an expense. Okay, so that is what you want to be thinking about when it relates to what is the IRS logic behind this. And then the other option is the IRS logic is something going to make it better? And then, the fixing the leak is not, yes, it makes it better, but it's not making the functionality better. You're making your client happy because you're fixing the salon. You're fixing something in the salon, but you're just keeping that sink in working repair. Like you're just repairing something that is supposed to function that way. You're not making it better. Now, let's say you were adding a head spa to the sink, and you were, installing a bed that you lay down, and you're turning like this sink into a whole experience, right? Okay, well, now that's not just keeping it running, that's making it better. So that's not going to be an expense. And I'm way off. I'm just kind of flying off the seat of my pants right now. But that wasn't the example I wanted to give you. I wanted to take it back to the water heater. So the water heater, remember, he's not fixing it. He's actually improving it. He's getting a bigger water heater. So this is actually considered an improvement. And so now it's an asset. And so assets are not going to be expensed in that full year. You're actually going to depreciate it over time. And so we call that capitalizing expenses. So you're going to capitalize this. You're not going to expense it directly. And so it's really important that you understand, because this can have a direct impact on if you're trying to get approved for loans. So let's talk about this, right? So when you are working with a bank and they are looking at your profit and loss statement, or let's say they're looking at your tax return, this right here, this water heater improvements are typically much larger in expenses, right? Now, the beginner business owner might be like, oh yeah, I need to write off all my expenses because I don't want to pay a lot in taxes. But you might be hurting yourself to get approved for loans, right? You want to be bankable. And so if you capitalize this expense, you actually what's the word? You extend the payments, like the expense, over a period of time. So instead of it being like $10,000 in the year that you purchased it, it would be like $500 for X amount of time until you get it. And so then you're showing more income. So again, these are strategies that you want to make sure that you're working with an advisor to, figure out. And that's exactly what we do at Hair CEO. Now, here's a pro tip, because you might be thinking, well, I don't want that. Like, I don't want to depreciate an improvement over multiple years. Like, I really do want to take the full expense that year. Well, there are two things. One is called the safe harbor. De minimis safe harbor. Yes. And so that's basically saying that you can you don't have to expense something and depreciate it over time. If it's $2,500 or less, then you can just expense it the year that you purchased it. And then there is bonus depreciation, where you can take something that costs, upward of $1 million, depending on limits at the time when you're filing your taxes, where you can take the full amount that year. But again, you want to make sure that you're working with your tax professional or an advisor to make sure that that's going to be the strategy that makes the most sense for where you are and kind of what you're doing with your business. If you're trying to get loans or approved for anything, then those are the types of conversations that you're going to want to have, because you're going to want to know, okay, what do we do with this purchase? I just purchased this water heater for my barbershop. Or I purchased this water heater for my salon. Or maybe you upgraded all the furniture. Maybe you bought all of these like stations for your salon, and it might not make sense to write it off all in that first year. So you're going to want to have those conversations. And, that's what we do at Hair CEO. So, if you are someone and you want to make sure that you're having these types of conversations with your salon or your barbershop, or if you're self-employed in the hair industry, then I want you to reach out to us. We're working with a limited number of clients for the 2026 filing season, which is for 2025. So if you want to work with us this year for 2025, then I'm leaving a link down below where you can secure your spot so that we can prepare your 2025 taxes. And if you're looking for just, getting some coaching, or you want to start working with an accounting firm for your bookkeeping and your accounting, then you may want to sign up for monthly accounting services, because we're in a new year. We're at the start of the year. Let's get these new habits going. And so we do not want to wait and let time slip away. So again, my name is Jennifer Drew, founder and CEO of Hair CEO, simplifying profits and taxes for self-employed hair professionals and hair business owners. And I will see you tomorrow. That's going to be day 16. We're in day 15 of 90. So I'm showing up every day for the first quarter of 2026. So if you're catching this replay, you should come live if you can. But yeah, I enjoy the replays as well. Let me know, and I will see you tomorrow when we talk about another tax topic for 2026.